Welcome to Hospitality Talks. I'm one of your hosts, Sam-Erik Ruttmann, and next to me I have Abid. Abid, how are you today?
Very well, thank you, Sam. A happy Wednesday. I hope your day has been going well. You approaching a late afternoon while we adjust in the morning time. So welcome to Hospitality Talks, everybody.
Yes, I'm absolutely delighted that we have some interesting guests today. And I'm sure we appreciate with Abid everyone who's watching us live. I know there's in US some other channels showing some very important programs. But if you're with us in live, I already say thank you very much. But more importantly, if you're watching us in a recording, thank you very much for all the replay viewers. And over to you, Abid, to introduce our guest.
Absolutely, Sam. We've got a fabulous panel today and appropriate to plausible predictions as we try to figure it out how to plan for 2021 and how to close out the chapter at 2020. So our panelists today include, first and foremost, Daniel Lesser, who is the president and CEO of LW Hospitality Advisors. We also have with us today Jeffrey Horwitz, who is senior partner at Proskauer, a global legal firm. Jeff has been involved in lodging, real estate, and gaming industry for a very, very long time. And last but certainly not least, Bram Gallagher, who is the economist and research analyst for CBRE Hotels. Gentlemen, welcome to Hospitality Talks.
Thank you. Good morning.
If it's okay, just so that we can check our systems and everybody works, I'm going to ask you some very, very, very small questions. And Jeff, if you don't mind, I'll start with you. Jeff, if you were to have a superpower, what do you think that superpower will be?
If I were to have a superpower... You mean apart from erasing the coronavirus from the globe, kind of a superpower?
Well, there you
go. Would be a good superpower. That would be great to eliminate infectious disease. That would be, but it's not the kind of superpower that you read about in comic books.
Well, there are all sorts of new super beings coming out. So a healer that can erase the coronavirus from the globe, that's a great superpower.
Yeah, but somehow I don't think the healer is going to be a big movie. So I may have to think back to like flying or something like
that. Dad, a question for you. Your childhood celebrity crush, who might that have been?
Farrah Fawcett.
Oh, there you go. I can relate to that.
I didn't have to think about
that. That's fabulous. And Bram, for you, if you were competing in Olympics, what sport would that be?
Well, in college, I used to row, so definitely not that. Those guys are much better than I ever was. So let's hope that they add hotel forecasting to the Olympics.
Well, gentlemen, we could start our own Olympics. There'll be a lot of Olympiads in the Hotel Olympics, so we could start our own thing. Well, gentlemen, thank you so much. Again, thank you for joining us. If it's okay, I'm going to get straight into that. And Bram, we're going to start with you with some questions, if you don't mind. Though most of this session is going to be about forward-looking, and we're talking about plausible predictions, but help us sort of close out 2020. Where did we end the year relative to the occupancy, and how far down was it from the year before?
That's a great question. So the COVID pandemic caused a massive disruption in the hotel industry. So my colleague, Robert Mandelbaum, he maintains this trends database, and it has data that goes back to the 1930s. So it's a very long series, and we've never seen anything like what we've seen in 2020. It was really an exceptional year. The hotel industry essentially shut down in quarter two. We've been making Some progress since then. There are some segments in particular that are developing some more occupancy as time goes on, but we're still down at least a third from where we were in 2019 as far as occupancy goes. RevPAR maybe half. So what we're seeing is that even at the end of 2020, we've still got a long way to go to get back to the performance that we were seeing in 2019.
Okay. In one of your most recent papers, you had talked about that first half of 2021 occupancy would be around 44% and second half would be around 56% for 2021. Help us understand where is in major markets, which markets are showing buoyant tendencies, which markets are coming back, and where this business might be rebounding from?
Sure. What we've seen in 2020 so far, in 2021 as well, is we've seen modest improvements in leisure markets and drive to. So drive to leisure markets. So in the summer travel season in particular, we saw markets that had access to a beach or other outdoor recreation doing pretty well. So some of the markets that we had noticed had come back the first were Virginia Beach, Jacksonville, so Savannah, and here in Georgia where I'm at. So these were markets that had a lot of drive to appeal that people in larger markets could access, and then had a leisure destination appeal as well. So that is the type of demand that we've seen that's able to come back. As we all know, business travel is still very much down. Conference, convention travel, all but eliminated. Some of the data that we look at, excuse me, booking channel and day of the week data that we get from Colibri Labs, our data partner, really suggests that all of the improvement that we've seen in the last 6 to 8 months, such as it is, has been in that leisure segment. So it's been weekend travelers, it's been travelers that book online or through online travel agencies. And we really have seen it come back in these drive-to leisure destination markets. Now, moving forward, this could change. Right? The vaccine is a very important development. It really is something of a miracle that we were able to develop a very effective number of vaccines very quickly, and that we hope that distribution will occur and will really get us to a different point by Q3. So one of the differences is, while the improvements that we've seen so far have been almost entirely in leisure travel and in that leisure segment, if there is an effective vaccine, if we can get general immunities in the population, we're going to see business travel start to come back. We think it's going to start to come back in Q3. So this could spell improvements, not just in those destination drive-to markets, but in some of the some markets that we consider more traditionally convention or conference markets, as well as business travel increasing in Q3. There is one hitch or one sort of hiccup to this sort of development, and that is the closures in some of these markets that are traditionally convention, group travel, business travel centric. So 3 of the markets that have had a lot of this business in the past, New York, San Francisco, and Chicago, still have significant numbers of hotel rooms closed. So in New York, for example, about a third of all of its hotel rooms in that market are now closed. In San Francisco, about a quarter. In Chicago, nearly 15% of those rooms are closed. So when we're looking at Q3, I think there's going to be an opportunity for some maybe some unconventional, a little bit off the beaten path markets to capture some of that group business travel, just because they're going to be able to mobilize those rooms a little bit more quickly than some of these large markets. So when we're talking about New York with over 100,000 rooms, when we talk about a quarter of them being closed, that's a lot of business, and that could mean a big improvements for some of these some of these off the beaten path markets to try to attract business in quarter 3 of 2021 of this year.
Bram, the group and convention business obviously plays a critical role, particularly when you look at the top 25 MSAs around the country. Are there trends that some of that business is starting to get back on the books? What are you seeing from a broad perspective?
Right, that is a big question mark. The group travel is very important, particularly in September, October, November. So in that quarter 3, quarter 4, that's the big convention travel season. Is when a lot of the business occurs. And it's crucially important to that upper upscale chain scale hotel, that type of hotel that really accommodates that type of business. Now, getting firm numbers on this in a really organized way has been difficult. However, I have been talking to a lot of heads of DMOs for some specific markets. I think that the role that the destination marketing organizations play, that visitors and convention center bureaus are playing, it's going to really be very important and crucial. And I think that the work that I've seen so far has been encouraging. I was talking to the Atlanta CVB. They're hoping to book a convention and group business, maybe up to 85% of the 2019 numbers. So that's encouraging for quarter 3, that they'll be able to mobilize again those rooms that quickly, that they're really being very proactive and trying to get that business. Not only is that a significant portion of business for that chain scale of hotels, really a type of hotel, but just for the business in general, the convention group traveler does pay a higher rate on average than the leisure traveler. So that business is very important, particularly the bottom line. So getting that business back in quarter 3, I think it is going to be very important.
Any other trends that we can count on? Any other positive news for 2021 where we can bank on? As you know, a lot of hotels are trying to do the forecasts, and what would that look like? Any evidence there that this will bounce back with the vaccines being rolled out and all the other things that are in the works today?
I think there's a lot of reason to have optimism. So a few things about those forecast numbers that you just mentioned. We have just gotten some new data in. We are now feverishly preparing our new forecast. But some of the assumptions going into that previous forecast that we had, 2 bits of news that were sort of contradictory at the time that we were trying to incorporate in there, was the development of the vaccine. So that was very exciting, positive news. But on the other hand, we had this big surge in infection rate. So that was disturbing news that we thought would cause definite near-term disruption. And something else that was important to those forecast was at the time that those were made, no further stimulus package was pending, and none was included right there. So I've heard a lot of overtures about aggressive monetary stimulus. So Janet Yellen, when she was speaking the other day, was bringing up the idea that we need to have aggressive relief stimulus. I think that's going to help out demand. The other thing that I'm thinking is that there is just going to be so much pent-up demand, both in leisure, as people want to get out. We know, for instance, that when you can provide an environment that the guest feels safe in, that provides a good experience, and that provides a reason and something to do when you get there, you can be very successful. Luxury hotels, for example, in November, the luxury hotels that we follow, the ones that were able to let rooms and gain some occupancy, all the open luxury hotel rooms were actually able to increase rates by as much as 10% over November in 2019. So even in the midst of this incredible surge in infections, in the midst of this pandemic, they were able to still increase rate. And the reason is, I think it really points to that pent up demand. The idea that the people do want to get out, and they will and are able to spend the money if they're being given the opportunity. So that's really exciting. I think that we could see numbers that are in excess of what we forecast this last time in Q3, particularly as this vaccine distribution rolls out. I think it's going to accelerate as we move forward. I think there could be a little bit of displacement as well. So we might see a little bit lower Q2 numbers as people put off that travel, but then that could spell a bigger Q3. And something else is that business travel, I think, is really hungry for a rebound as well. All this technology that we've had, I think it's been remarkable. Just within my company, the way I've been able to connect with a lot of colleagues that I hadn't connected before across the country. But this has also given me a reason that I never had before to travel to destinations across the country as well. So I've got some partners in Charlotte that we've been discussing hotel data with for this last 9 months or so. And I never had a reason to go to Charlotte before, but now I think I really want to go up and meet the team and be able to do some work with those fellows. So I think that there is a lot of reason for optimism. I think there's a lot of pent up demand. I think there's a lot of hunger for travel, both in the leisure and in the business segments.
Well, that's a great news, and Bram, I'll turn it over to Sam here in a little bit. That's very encouraging news because we all know 2020 was a bit of a bloodbath for the industry. So all these green shoots are very, very encouraging and helpful. An article that most recently was published. Bill Gates, I believe, was the one that had said that the business travel as we had known in the past might not exist anymore. Now, there is a massive debate whether some of the business travel is going to completely go away or not. But it still remains to be seen. I'm of the opinion that human beings have an innate in their DNA to want to meet people in person. So our industry will bounce back and it'll come back with a vengeance. At least that's my hopes are. When it happens, still remains to be seen. So let me turn it over to Sam here, and I'll be back with you in a second. Sam.
Thank you. Yes, I think also here in Europe we are discussing this continuously, what is happening with the business travel. And of course, destination marketing offices are of course trying to be very positive, but at the end of the day, people are emotional and they need to have the sense of security. So wouldn't you agree that there is still that chance that, well, people want to wait and see to make sure they are protected before they will enter a convention, even if they have an opportunity to join a virtual conference, because of the fact that everyone may not take the vaccination, and we don't know yet how effective it will be. What are your thoughts on that? Or what are the people telling you on the ground at the destination marketing offices?
So besides some of that booking activity that I discussed earlier, there are some unknowns with the distribution of this vaccine. We had hoped for 20 million people vaccinated in the U.S. by the end of 2020. Of course, it's gone a little bit slower. We've exceeded 10 million vaccinations recently, but I think things will pick up. It's like everything else in this outbreak. We are learning by doing. So as we move forward, I think things are going to be quicker. There's been some skepticism in some areas about taking the vaccine, but I think that's going to evaporate. Once you've got 50 million people or 100 million people vaccinated, I think all the holdouts will realize that this is not only safe, but it's the only path forward. There's no joke. I mean, it's no joke to say that the next 2 quarters are going to be very difficult. for the hotel business, and for the world at large as well. It's going to be a difficult time, but I think if just looking at this, if things go forward as we expect, as it looks like they have every reason to do so, I think people will have a sense of safety again by Q3. I think they're going to finally be convinced of the effectiveness. There may be some additional displacement, as I said, so delay of plans from Q2. I think they could land in Q3, or late, maybe late Q3 or maybe even early Q4. But I think that the effectiveness will be demonstrated because we'll have a pretty quick turnaround to some of the gruesome numbers that we've been seeing in recent days.
Okay. In terms of new supply coming into the market, is there anything on that front that you have information on? Are people still planning opening new hotels? What is the information available for 2021?
That's a great question, and that is something that we have been thinking about and talking about since the outbreak started. We were very concerned at the initial stages of the outbreak that there were going to be massive construction halts, and there were some announced construction halts that we were following, but most of these seem to have lifted. Construction has resumed. In fact, almost all of the rooms that were under construction at the start of this outbreak here in the States, we believe will be completed close to on time. But we have seen major disruptions in new starts. So if you weren't under construction, if you were in the planning or final planning stages of your project, then almost certainly you deferred the construction start in 2020. So this is going to mean that the supply is going to continue to increase through 2021 as those hotels that were under construction open. But it's in 2022 where we're going to see some big gaps. And this is when those hotels that were going to be started construction during 2020 and 2021 were put off. That's when they would have opened. We won't see them open. Therefore, the supply growth should decline meaningfully in 2022 and some of 2023. On the bright side, if you're a hotel that's already open, this could help with your occupancy. A little bit less competition is not going to be the worst thing for a lot of hotels that are in business right now.
Excellent. Well, thank you. I'll pass it over now to Abid for the final questions for you.
Thanks, Sam. Bram, some of the hotels that are shut down, and we'll hear more about it from our two other panelists, they might never reopen either because of the capital structure or financing not available, or they're just functionally obsolete. How much of the stock you think will be taken out of the market through this process?
That's a great question as well. Certainly one that we've been pondering. As my old colleague Jamie Lane used to say, the hotel industry is an under-demolished industry. So there are those functionally obsolete products out there. So when we're looking at the closings, and when I talk about the massive closings that are occurring in New York and San Francisco and some other markets, I'm speaking to temporary closures. We're still including those in our occupancy denominator. We think that most of those are going to eventually return, maybe not under the same ownership, but most of those locations are going to eventually return as some lodging product. I should also point out too that those temporary closures are very heterogeneous as you go across markets in the US. So once we get past those maybe top 10 or 15 markets, the rate of temporary closures even is much smaller. So less than 5% of the rooms closed when we get outside of those big major markets. So that's encouraging to me that a lot of that product too is probably, well, it's already come back and it probably won't be permanently closed. We had worried about at the beginning, there was some talk of conversion of some hotel space to say multifamily or some other use. We haven't seen a lot of evidence so far that it's happening on a mass scale. So I think there will be some permanent closures. We haven't exactly what the percentages are. I've seen some sort of disastrous predictions coming out of some corners, but right now we're not seeing or anticipating enormous numbers of hotel rooms permanently closed and never coming back as lodging.
Fair enough. One last question, and we'll bring in our next guest, Bram. If I was to be looking to buy a hotel, what hotel tract or positioning or what market do you think would be most suitable, at least for the next 3 to 5 years?
Well, I mean, there's always opportunity everywhere, right? You could be looking at some big convention hotels if you want to pick up some hotels at the bottom of their market. But on the other hand, what is going to be performing very strongly coming up? I think, again, the select service that's been a popular answer for years now, it's still attractive. We've seen the bottom line performance in that group of hotels across the nation has been well. So food and beverage revenues have been hit pretty hard, but the select service is a very nimble product and allows sort of a lot of good bottom line translation. But selfishly, if I was going to invest in a hotel, it probably would be that luxury drive-to destination resort, because then I could visit my property and enjoy the amenities myself, as well as enjoy some great performance. I think we're going to see enduring for the next year.
Fabulous. Well, thank you for that, Bram. Please stay with us. We'll have you back in a bit, but at this particular point, I'd like to bring in Jeffrey Horwitz. Jeffrey, where did we get you today? Where are you based today?
Today I'm in Connecticut.
Oh, okay. Well, thanks again for joining us, Jeff. You had been over the at least past 5-6 years or so. You were very actively involved with some major M&A work. Tell us what that landscape looks like. Are there more M&As that we can anticipate? Is it pretty much done? What would that look like?
Thanks, Abid. I think M&A thrives in a period of dislocation. So I think that this period is the greatest dislocation that I think anybody that's certainly on this telephone call has ever seen or experienced. I don't think we have many that are over 100 years old on the call, so I think there's going to be more of it. I think that there's going to be greater consolidation. People are going to, just like they do in any kind of time of trouble, people come together for protection and support. The same thing is going to be true for businesses and companies and portfolios. So I think there's going to be continued consolidation of every kind for the hotel owners, the hotel operators. Maybe less so for the investors or the lenders, but who knows? But I think there's going to be ample opportunity for M&A.
Sounds good. There are obviously lots of benefits, but it presents lots of challenges. As a result of all the M&A activity that occurred, have you seen any changes in operating agreements, whether they are management agreements or franchise agreements? Were there issues that popped up either from the lenders or the owners that have changed how these agreements are written?
So let's see. I think key money has become it was precious before, but it's become ever more precious because the operators don't have the capital lying around to say, okay, I'll throw some money at this and grab that management contract. I think that obviously everybody is reading their force majeure clauses and those kinds of things in a different way. There may be some new negotiation regarding what happens in a non-revenue environment where the contract is continuing and the operator is still providing services. How does the operator get paid for those in some even if it's just reimbursement, some reasonable way that's not based entirely on a percentage of revenue. Whether that deal gets recut or not, I don't know. There has certainly been a tremendous a tremendous focus on cost savings. I think that, you know, in the beginning there was the rush to make the hotels safe for occupancy, and I believe that those costs got absorbed, but also offset by, you know, employment changes in how often rooms are cleaned, changes in the kinds of services that are offered, and I think you'll find a lot of those changes ending up to be permanent. How those decisions are made, and you know, those kinds of things may be renegotiated in the contracts between operator and owner. You're going to see some obvious changes with the unions. So I think it's going to be an active area. People are going to have to look at those agreements a little more carefully, in a little more context, because I don't think anybody negotiated them with the view that we could be in a prolonged, essentially non-revenue environment or constrained revenue environment.
Fair enough. In US, at least, the conversation relative to business interruption insurance has been that none of these policies covered what we have just been through and continue to go through. But I was reading an article, I believe.
That's what the insurance companies say.
Well, to be honest, all the owners and operators are wishing that the answer was different, but that's the answer that has been given consistently. But I was reading an article recently. The UK Supreme Court upheld the decision in favor of the business owners. Do you think that would have any impact in the US?
Well, it has no technical legal impact, but yes, I think the fights have not yet been fully waged. The insurance companies said that they're not covering it. Okay, and so what, like a lot of insurance companies do, you know, sometimes if you have the wrong insurance company, it can happen to you with your home or your car or other things. The insurance company is making it difficult to recover. Okay, it's not necessarily a surprise, and they're protecting themselves, and that's fine. But if and when people are able to wage these battles in full, we may actually see that that's not necessarily accurate. We have a case involving a company that went bankrupt. It's not a hotel company or a lodging or leisure company. It's a retailer, but there's a significant insurance claim that was auctioned off as part of the bankruptcy process, and there's a buyer, and I know that there are hedge funds looking to buy up these claims because there'll be strength in numbers, and I don't think this particular chapter has finished being written. And you know, I don't know what's going to end up when the insurance companies finally do have to pay the piper on it. So I think that's still an open question. But no, they're not just going to write the checks, you know, immediately. It's not going to happen.
I guess that's pretty prototypical of any insurance claim, no matter how small or large it is. In this case, because of pandemic, unfortunately, the claims are pretty substantial. But I'll turn it over to Sam in a bit. But if you look back and moving forward,
I'm sorry to interrupt you, but just one important other thing. There was a decision
please.
in the Ambang Murray case that was decided by the Delaware Chancery Court. There was a ruling that the term calamity includes, in an M&A contract, includes the pandemic. So again, it doesn't have precedential legal effect. It was not an insurance contract. It was in a particular state. There are lots of other factors, but I think you're going to start to find people coming up with common sense readings of what is covered and what is not covered. And it really comes down to what the policy is. Insurance is not there are legal concepts around insurance, but it's a contractual matter. What did you contract for in terms of your protection? And all that boring language that nobody ever wanted to read is now becoming more relevant. So I think there are gonna be a lot of little factors like that are gonna come into play. Sorry, I didn't mean to interrupt.
No. That's a very crucial point, because quite candidly, every conversation that at least I've been involved in, it's a point of frustration for a lot of the hotel owners and operators that they've been left holding the bag, even though they've been very good in paying the premiums, and everything was crossed and every I was dotted. But unfortunately, this claim is being denied. It's more prevalent even in restaurant industry, because a lot of restaurateurs have been completely wiped out, unfortunately, as a result of pandemic. But it'll be interesting to see how that comes out. Hopefully it'll be a win-win, but I'm not sure what that would look like. Relative to looking back and looking forward, the biggest issue facing hotel operators, if you were to look back the last 5 years, put the pandemic in and move forward 5 years, what do you think that the hotel operators are up against? Some of the big, tough issues coming down the pike? And I will turn it over to Sam after this.
You mean in the coming 5 years?
Yes, please.
So, I mean, listen, the big operators have big machines, and they, so the difficulty is, how long can you keep the big machine going when there's not a lot of inputs? I think it's one of the few cases where, unless you accidentally luck out by being in one geography, not another geography, the more global you are, probably the better you are, because the recovery will not be the same everywhere. It'll happen faster in some places, slower in other places. And if you can keep so big operator, it's to keep everything afloat and make it to better times. There's also the constant, it's not a threat, but there's this constant question of what business are you in, right? You have, at the beginning of the pandemic, in March of 2020, I think most people would have said that Airbnb was not worth a whole hell of a lot in terms of its prospects. Somehow, by the end of or not the end, but by this point in the pandemic, it's a wildly successful, or seemingly wildly successful, public company. And I'm not commenting at all on Airbnb or its prospects, but now it's got a much more valuable public stock. So that was more valuable than a lot of the hotel or travel related companies by a large factor. So one of the questions is, what business are you in? Are you in a business that the stock market, which is sort of it's essentially a casino of the future, right? That the stock market values going forward, right? And what does that allow you to do to preserve yourself? If you're just treading water and you're just staying in place, you may be losing ground. For the large companies, I think that's a real question. How do you continue to do what you're doing and do that old maxim of stick to your knitting, but also see that people may not be buying knitwear, right? So how do you keep that going? I think that's that's for the security prognosticators, but I think that's the key challenge. There are lots of other challenges, but I think that's the key one.
I think that's a great dilemma that a lot of the brands and the operators are grappling with, and hopefully we'll have an answer. But the consumer is going to decide what do they want to have. The consumer is very smart these days, and they almost force the issue as to what they want to have and how they want to have it. So let me turn it over to Sam for a bit, and I'll be back with you in a second. Sam.
Yes, thank you, Jeff. I basically had just one question. What is the sentiments now in terms of the ownership, and also maybe the threat felt by operators that might be a wave or reflagging the property because of the developer may not trust that, or the owner may not trust that after the COVID-19 that that particular brand will be very successful, or should they now reposition for different type of segments? What are you hearing about these kind of thoughts in the market?
I don't think that, I mean, listen, I think that where the operator doesn't really want the hotel in its system, the operator is going to look for a way to get out of it. So I don't, I think that's going to happen. I think in terms of owners deciding that one flag is better than another flag, in terms of operating the hotels in COVID, I haven't really seen that. I think all the operators are doing their darndest to get these hotels operating, in a clean and safe fashion, not only for the guests but also for the employees. And so I don't really see people deciding that brand X is better than brand Y on COVID. I do think that that the level to which there's cooperation on PIPs and other things in a time of tremendous capital constraints for the owner is that's going to continue to be something that people are looking at. I again think that reflects a lot whether the operator wants that brand in in the system, and I think people will make mutual decisions about how to reflag and what the hotel should be. It's kind of hard to. It would be a good time to have your hotel under construction because it can be closed anyway. But other than that, I don't see a wave of reflagging. I really don't.
Yeah. No, just the reason I brought it up, because I also deal with the Middle Eastern market in Dubai, and now owners are looking at creating, for safety for the future, that they're creating a mixed-use product. For instance, like the part of the building is a hotel and the other part is a hotel service apartment, because the logic is that when there is no business travel and so on, you may have some domestic travel, or we may have people on a long stay basis. So they're trying to find always some practical and pragmatic ways to protect themselves in the long term. And I just wondered whether that's in the case in the US, but Middle East is quite prevalent now that the owners are really rethinking.
It's always been a surprise to me. We in the United States have never had the extended stay product that go all the way to serviced apartments to the extent that occurs not only in the Middle East but in Asia and in other parts of the world, and that may be coming. The entire concept of mixed use is an interesting question, right? Used to be anchored by grocery stores still work because people need to eat, but what about movie theaters? Right, you used to have a movie theater to draw all kinds of people to the facility at night. Not happening, and there's a big question there as to whether it will ever come back, right? Will with all of the availability and convenience of streaming, will people want to go into big dark rooms with people that they don't know? For old guys, that was a fun experience, but it's not happening that way anymore. So I don't know, and what uses are going to be mixed those are going to be interesting questions.
Yeah, very good. Thank you very much, Jeff, and over to you, Abid.
Thank you, sir.
In terms of capital restructuring and financing that is available, and we'll talk a lot more about this with Dan, but in documents, the loan docs that are being prepared, are lenders looking for something dramatically different, either as a result of M&A and or pandemic?
I think that one of the things that the pandemic has done is focus everybody again on bankruptcy as an alternative. And what does bankruptcy, how does that work, and how do the documents work? And I think that the lenders will be even more careful to protect their rights. I think people are, we have a whole generation of people that didn't go through this any kind of a downturn, and so have not really ever understood what foreclosures mean, if UCC foreclosure versus a real estate foreclosure. I think that people are now much more focused on rights and remedies and how guarantees really work and what is their ability to take control. I think you might see the use of proxies more in addition to just a pledge. I think the lender needs to be able to take over more easily when it wants to, or that, from the lender's perspective, and they're going to try and get those rights. And in a lot of cases, they may well do.
Well, thank you, Jeff. I think that's a great segue to bring in our next guest at this point. Dan Lesser joins us. Dan, are you in New York today, or are you out and about?
I am in just outside New York City in Great Neck, New York, which is where my primary residence is.
Well, thanks again for joining us. Dan, from your point of view, you're dealing with the hotels not only from transactions, you're dealing with it from asset management, you're dealing with it as a servicer. Do you have any further thoughts about the availability of capital and what are people doing while we're trying to survive for, let's say, the next 6 months so that we can continue to either service our debt or get some forbearance or whatever it is that we can do to survive for the next 6 months?
So that's an interesting question. The first mention of available capital.
Then you're coming in very low. Your voice is very low.
Okay, I'll talk louder. Can you hear me now?
Sure.
Okay. In terms of available capital, I've been doing what I do for just over 40 years, 40. And I don't recall there ever being as much capital available in the market that is chasing yield and focused on commercial real estate from all over the world, including domestically, in the United States, real estate, and then drilling down even further to hotels, because it's been proven time and again that if purchased correctly and under the right premise on a risk-adjusted basis, hotels clearly produce superior returns. So the notion of capital being available, there's tons of it. It's interesting that it seems like every downturn there's a new buzzword that comes up. This time it's rescue capital. I mean, that's really, it's just a fancy term of capital being available. Let's face it, a lot of people and investors will lose money, right? But somebody's loss is somebody else's gain, right? So I think there are going to be, well, there already are some tremendous opportunities out there. With that being said, I do believe and think we've already seen that, listen, for the compelling opportunities, right? Not every opportunity is a compelling opportunity, but for the ones that are, there is so much capital out there that ultimately the transactions will be initiated due to distress. But because of all the capital out there, these opportunities will get bid up, and invariably they will not necessarily reflect distressed pricing.
So, Dan, 2020, I believe the transaction volume from a year-over-year perspective was substantially down. I was just reading your recap that you had generated. In value terms, I believe it was down nearly 70%. Now, moving forward, if there are to be transactions, if there are to be refinancing issues, appraisals are a huge issue. How do you appraise an asset in today's environment when visibility is non-existent, essentially?
Great question. And I'm asked that all the time. Listen, we do the best that we can, no different than every other prognosticator out there, right? Nobody in February of this year was projecting that the sector would fall off a cliff in April, right? Nobody knew that. I was somewhat amused. I have been in the past as well when demand shocks come up, how immediately afterwards there are some who step up and talk about the impact on values within days of a negative event. And I scratch my head a little bit because this is, again, this is what I've done for many, many years. It's a passion for me. It's a hobby. I love what I do. And I scratch my head because I'm like, well, wait a second. I don't know that. And this is what I live and breathe day in and day out. How do you know that? Right. So listen, coming back to your question about valuation, we are charged with reflecting the market. We don't create the market. We reflect the market. Right. So during times when some people might characterize hotel values as being frothy, you can characterize them however you want. If that's the market, that's the market, right? So today, you're right. Their clarity is starting to appear as time goes on, and we're starting to see trades that were reportedly in contract pre-COVID, but didn't close until after COVID. And so we're seeing a band generally, I would say, of between a 20 to 40% decline pre-COVID compared to today. Now, that is a general band. We've also seen assets where, believe it or not, value has held flat. And we've seen other assets where, value is down as much as 70%, 70.
Wow.
The fundamentals of valuation, again, we reflect the market, and hotels are income-producing real estate. So it's all about cash flow, and some more cash flow, right? Today, when you're doing a projection of income and expense for a hotel, in most cases, it's like similar to looking at a new hotel, right? Because whether a hotel's been closed during COVID or not, if it's running at 10% occupancy, for all intents and purposes, it's closed. So investors are doing a projection of income and expense, baking in an assumed horizon for recovery, and doing a traditional, discounted cash flow analysis. Obviously also cross-checking that conclusion with comparable sales, and we're starting to see some comparable sales. There's no investor out there that formulates a pricing decision merely on comparable sales. And then, of course, comparing to replacement cost, right? I think it's going to be quite some time before we actually see assets trade above replacement cost. There are going to be there already are significant discounts relative to replacement cost. So the fundamental premise, again, of appraisal valuation hasn't changed.
So Dan, you bring up a great point. There are very few comps. So when a transaction is about to occur or an investor is evaluating an asset, whether it's comps or you're looking at cap rates, there has to be, I guess, healthy transaction market for those measures to be applicable. How are people evaluating whether an investment works for them or not? Capital, though it might be available, my understanding is at least the debt is relatively expensive. As I was told, that hotel from a debt perspective has become a four-letter word, and a lot of people are not really that keen. What have you seen, and what are your thoughts relative to all these different indices that we've used in the past to transact?
So actually, you are correct that hotels became a dirty word in the lending community, but that is rapidly reversing itself. We're seeing more and more capital becoming available for debt, not just equity. Even hearing smatterings of CMBS availability of capital, which is kind of mind-boggling when you think about it. Cap rates, we could spend the whole couple of hours talking about cap rates. I've never met an investor who prices an asset based on a cap rate, right? Which is theoretically taking a single year's income and applying a cost of capital to come up with a valuation. The problem with cap rates is nobody really ever defines, okay, which cap rate are we talking about, right? Are we talking about projected year one? Are we talking about trailing 12? Is it after management fees? And if so, how much? Is it after management fees that include incentive fees? I mean, so there's so many variables. I once put out an article that analyzed a transaction, a sale transaction on a $50 million deal. And from the same transaction was able to extract upwards of 8 different cap rates that varied between 5 and 10%, right? Depending upon if you're looking in the past, forward, and what level of income, right? So cap rates in and of themselves they're really not that meaningful. I know, people talk about them all the time, but I don't find them. And typical investors, again, they talk about it sort of in passing, but nobody formulates a pricing decision on that. And then in terms of sale comps, I mentioned earlier, again, nobody prices an asset based on what the hotel across the street sold for, unless it's identical, which you rarely find. And as I mentioned earlier, we're starting to see a handful of transactions. The Renaissance in Austin, I think, is one of the latest ones that sold for. Xenia sold for $70 million. They had a contract that broke up in April at $100 million, right? So there's market intelligence that actually shows us a 30% decline, right? You can look at the Waldorf in Chicago that just traded for, I believe it's $54 million. Really interesting transaction because that, I believe, works out to like $250 a key. And granted, Chicago has challenges, but when you look at that asset from a physical perspective, that's amazing real estate for $250 a key. The other interesting point is that it was not that long ago that the asset sold in a market environment for more than double that $54 million. So we are seeing price discovery bubbling up as time goes on, and we're going to see more and more of it.
So up until now, at least what I read, and you bring up this Waldorf in Chicago, I would have thought that is far, far, far below the replacement value, and it was a very interesting transaction. But up until now, the bid-ask spread has been huge, and I think that's why possibly the transactions have been somewhat anemic. Do you see that closing? Do you see that the values would come together on the upper end, or the discounts would be bigger?
That's also a great question. At the end of the day, I'm not really sure why anybody would sell a hotel today if they didn't have to, right? So, and let's face it, market participants have been playing nicely in the sandbox, whether it be debt, equity, operators, brands, et cetera, right? I think the sharp elbows will be coming out in the not too distant future. There's only so much that you can, sort of play nicely, as I said, in the sandbox. And once the pandemic is in the rearview mirror, which I don't believe it's a matter of if, it's just when, and I have no idea when. But once it is, I think the sharp elbows are going to come out, and you're going to see a lot of sort of, I guess, alluded to earlier, distressed transactions, not all of which will necessarily reflect distressed pricing.
Fair enough. I'll turn it over to Sam, but before I do, any advice for owners that might be feeling the pain right now? Anything that they can do to stay afloat and be sort of the quote unquote the good sponsor, if you would?
Pray.
Well, we can collectively do that.
It's also a terrific question. Listen, transparency is something that's always important, right? And I have spoken with several special servicers who, characterize good borrowers versus bad borrowers, right? So good borrowers may be in default now because of COVID, right? But they never missed a payment pre-COVID. Uh, um, when they're given a list of requested information, they provide every bit of it. There's no negotiation. Just give us the information, right? It's amazing that there are groups out there that are not necessarily that transparent. And so, again, I've heard special servicers say there's the good borrower pile, which is about this thick, and then there's the bad borrower pile, which is like this, right? Folks that either missed the payment, or didn't step up when they realized that they were going to start missing payments, and it was only after missing them and the master coming around saying, hey, what's going on, and then having to transfer them into special servicing, right? A good borrower, according to these specials, raised their hand before anybody contacted them and said, hey, we're going to miss payments, and put us in special servicing, which is a little counterintuitive, but again, this is what I hear the market saying. So I think transparency is really the key.
Fair enough. Well, thank you for that. Let me turn it over to Sam here for a couple of minutes, and I'll be right back with you, Sam.
Thank you. When I'm looking at from asset management point of view at the hotel property, I always look at the various facilities like restaurants and spas. And is there a question now where, particularly during this time and probably when the time is that we are looking in the rearview mirror of pandemic, that there's a trend that now we need to review the facilities that were not doing that great, and now it's time to change the concept or do something else with those facilities that were not doing that well, and in order to be ready for the market again.
Well, that's a phenomenon that frankly should have always existed, right? I mean, at the end of the day, when you're operating income producing real estate, it doesn't matter which asset class, it's all about profits, right? That doesn't count the ego capital that does get attracted to the lodging space. But yeah, that really is not a new concept. What I would weigh in on is that my humble opinion is that the sector has historically been way behind technology, always a follower, not a leader. And I do believe that now technology is being widely embraced, and that the sector will be ahead of the curve, finally. I hope so, because it's important. So I think, embracing technology is really, it's here, it's now, and should have been doing it before, but if you don't embrace it going forward, you're definitely going to fall behind. Think about a keyless entry, right? That's actually been available for quite some time, right? And it was reserved for the elite travelers of different brands, right? I'm not so sure how much sense that really made. If the technology was available, make it available for everybody, which is what's happening now, right? It's going to be available for everybody. In some of the conversations you had earlier, two things I'd like to just kind of point out. I think there was a little bit discussion about sanitation, and maybe there wasn't, but in any event, I do find it interesting that the American Hotel and Lodging Association, got together, came up with a great protocol for everybody to sort of adhere to, right? And all the major brand families bought into it. And then each brand family took it further and tried to come up with their own spin on cleanliness and sanitation, which I don't think they did themselves a service by doing that. It creates confusion in the market, and I believe it's problematic for the lodging industry to now be competing based upon sanitation and cleanliness, which is something that everybody always expected and still expects. And then the last thing I'd like to point out is that there was some discussion here about Bill Gates. And while I respect and admire Bill Gates, he's a a genius when it comes to technology and philanthropy. But him opining on business travel is the same as me opining on the future of technology. I'll leave it at that. Thank you.
Thank you. Yeah, I concur with you about this technology because the industry has been always behind the curve, and I think it took, particularly now, the situation that you have to invest into it, and the cost is going down in investing into technology, and customers expect it. So that's a very.
I mean,
very
look at the notion of online travel agencies, OTAs, right? They came into the fore during the last downturn, right? And shame on the hotel industry for giving up their most precious commodity, right? Which was room nights, available room nights. And they gave up control of that to the OTAs and frankly have regretted it ever since.
Yeah, I mean, and also that they don't know who actually is the customer who's coming. It's all handled through the OTAs. But I think I only know one chain, maybe there's only a few chains that actually have resisted it. There's one of the Uber luxury Aman group that only has their own booking system that you cannot book them through the third party. And I have a feeling that there'll be more and more of these hotel companies or hotel operators that will start to gear into that direction and creating a relationship with the customer on their own platforms rather than through these OTAs. So that's yeah, good. Well, thank you very much. I'll hand it over now to Abid.
Dan, you bring up a great point on technology. As a matter of fact, University of Washington had done a survey recently of the travelers, and particularly during pandemic, 70% of the travelers had said that they would require contactless technology to be implemented before their confidence will be there so that they travel. Well, that's from a consumer point of view, but internally we know that implementation of some of this technology can also reduce the business acquisition costs, but also labor costs, which is one of the biggest chunk of expenses that we have. Dan, if I was to be buying a hotel, where do I go to get the money? You talked about CMBS showing some liquidity and some money there. Is it balance sheet lenders? Who do I go with my hat in my hand to beg for money?
Well, it depends on what you're looking for, debt or equity, right? There's a wide variety of sources out there, both foreign and domestic. Capital that's priced very favorably to expensive money. It really depends on what you're looking for. Are you looking for mezzanine financing? You're looking for first mortgage financing? Like I said earlier, equity. In any one of those segments, there's no shortage of folks to go to, whether it's private debt funds, balance sheet lenders, banks, insurance companies. There's a tremendous amount of private equity out there. Again, that's earmarked for the space.
Fabulous. Well, thank you for all your input. Sam, if it's okay, let's bring everybody back in, and we can have some final discussions. And Dan, continuing the conversation with you, which markets are you seeing most distress in relative to real estate side of things and hotels going in distress, and which markets have appeared to be more resilient?
Well, clearly downtown, the former darlings of the sector, downtown urban core 24/7 markets that theoretically had high barriers to entry for new construction, right? And then I would add, these are the most challenged today. And then I would add that within that subgroup, those that are influenced by labor unions, right? So New York is probably the poster child of what used to be a darling market and today is, talk about a big no-no. But quite frankly, I tend to think very contrarian. And I think that's where the opportunities are going to be, in the New Yorks, in the San Franciscos, and the Chicagos, right? Let's face it, any investment, not just hospitality, but any investment, it all boils down to what's your basis in a deal. And so, I like the idea of, big box hotels in downtown urban cores. If they become available, I believe that they're going to trade at fractions of replacement cost. In terms of resilient markets, obviously drive to has we've heard that a million times. It's pretty logical, right? But I'm not so sure that that's where the opportunities are going to be to get deep discounts, right? Drive to resorts. I don't think that's where the opportunity is for deep discounts. That there's always going to be opportunity, right? But again, I like to think contrarian, and I like New York. I mean, listen, if you don't believe New York is going to come back, probably don't have a great outlook on the whole world, right? New York will come back. It's going to take time, and part of the challenge is that the sector over a number of years has shortened the horizon of holding period, right? Hotels are fundamentally, and they always will be, they're long-term investments, right? And groups that underwrite at 3 to 5 year holds, that could be a dicing proposition, right? Think about anybody that closed on a hotel in December, January, or February of this year, right? If you underwrote on a 3 to 5 year hold, right, the prognosticators are saying that the sector will maybe be back to 2019 levels 3, 4, 5 years from now, right? So if you bought on that premise, good luck, right? Now, don't get me wrong. Lots of money was made by folks who bought in 2010 and exited in 12 and 13, right? My point being that I believe it's really important to underwrite. You need to be prepared, ready, willing, and able, if need be, to hold on to an investment, hotel investment, for 10 years. That doesn't mean that if a capital event opportunity bubbles up, whether it be a sale or refinancing, in year 2, 3, 4, 5, whenever, that you wouldn't pull the trigger on that. But that is a real issue in terms of the notion of, well, we're going to only hold it for 3 to 5 years and hope for the best.
Well, particularly the institutional money, and you talked about private equity having a war chest of money that they are ready to deploy. Their typical cycle is 3 to 5 years, and they got to exit. So I think you are right that the churn in the asset class has increased over the years dramatically. The long horizon, long-term holds is almost an exception. Jeff, you have dealt with some transactions recently, but over the long period of time. What are you seeing? How are investors evaluating these investments? Is it to get in and get out, or are they a longer-term horizon that people are considering?
I don't think anybody's got get in, get out in the current environment, right? You've got to be making a longer term play. Listen, I think Dan described it correctly. The day after everybody got thrown out of their offices, everybody assumed, oh, I'm going to get a great big discount. It just doesn't work like that. And given that the capital stack was forgiving at least through the end of December of 2020, for the most part, people limped along. That's not to say there weren't trades. There were trades, and some of them were at deeper discounts than others. But the Waldorf in Chicago notwithstanding, and who knows why there should be a Waldorf in Chicago, that's a whole separate discussion. The 30% just wasn't there for everybody on every deal, and people are waiting. And I think in 2021, you're going to start to see the spread between a 30% haircut and a smaller haircut start to come together. A lot of it's going to depend on whether the vaccine rollout, certainly in the United States, but elsewhere, can happen faster, and how much, what people, they're always looking forward. What do they see as to when you can get back online? Whether people indeed believe we're going to have a roaring 20s and people, can't wait to get back out on the road, Bill Gates notwithstanding. And so I think you're going to start to see that spread narrow, except in, just like anything, every hotel is in a fixed location. And so a lot of it depends on you can talk about the broader market all you want, but you got to talk about that location, that capital stack, those partners, those investors, those lenders, and that operator, and see where you get to. We just had a transaction close last week that hit headwinds right in March of 2020, and it closed with the same parties, basically at the same price. So wow. Pre-pandemic pricing, and we're talking about a 9-figure purchase price. So it depends. It just depends.
The buyer may have very well been the winner in that, because they didn't have to suffer the current cash burn that has occurred since the pandemic began.
It could have been in this particular case, because it was an airport hotel and it remained fairly open which is one of the reasons why the pricing didn't drop. It wasn't entirely the case, but the seller was glad to sell, the buyer was glad to buy. There's always another story somewhere else, I think, is the way to think about it. Somebody always has a different perspective.
I think no matter how big or small these hotels are, our industry is, at the end of the day, it is still the street corner business. It's location, location, location. And that particular hotel's needs are very different than the hotel in the next block or the block over. Bram, any further thoughts on 2021 trends? I believe CBRE had projected pre-COVID RevPAR return somewhere around 2024. Do you see that there is a possibility we might get there sooner as the vaccines are being rolled out, or are you still holding to that 2024?
So that 2024 number is an aggregate. So there are segments that are going to come back earlier, we think. And it may be that when we're looking at the forecast with the vaccine, with robust stimulus, perhaps, that we could see a return a bit sooner. So, what is going to take a little bit longer is building up that group travel, that business travel, conference travel. There's a high ADR customer, and there's some really high profile assets certainly that take advantage of that depend on that business. And that's going to take a little bit of time to build up. On the other hand, you've got some select service, you've got some even extended stay hotels. They're going to come back, very quickly. Extended stay hotels didn't see nearly the impact that other property types did. Those should be coming back much sooner, maybe by 2022. And something else to keep in mind, we're benchmarking all of these hotels against 2019. And that was a very high performing year for hotels. 2018 and 2019, we saw record occupancies. A lot of markets were at or near record high occupancies. Now the ADR performance, perhaps because of OTAs, perhaps because of competition from Airbnb, it wasn't quite as strong, but from an occupancy standpoint, certainly very, very strong performance. So it's going to be hard to get back to that high level. On the other hand, we have seen with the P&L statements that my colleague Robert collects, what we have seen is some pretty remarkable cost-saving efficiencies. So there may be a return to bottom line performance a little bit sooner, or even concurrent with top line performance, which would be an exciting development.
Well, thank you. I know we are approaching the end for the time that had been allocated. I've got a gazillion other questions, but we might not have time. Sam, are there any questions? Unfortunately, I haven't really been watching the questions online that might have come up, but anything else that we need to talk about, because we are fast approaching the end of our time?
Well, I think
we're kind of at it.
What's that?
We're at the time.
That's right.
I'm sorry,
that is correct.
I have to run at 11:15, so I apologize.
No,
fair enough.
Yeah, there is just sort of thank yous, which are just a shout out to Sam Björklund who joined it, and so thank you very much for joining. And Jeff Horwitz, thank you very much for joining us today. Appreciate it. But no,
Well,
there's no questions coming out of this at the moment. So over to you, Abid, and we can close the episode.
I think we have reached time, but one last thing we typically traditionally end the session with is sharing something personal that you might have learned during the pandemic. So if I may start with you, Dan, anything that you might have learned about yourself?
Yes. So, truth be told, I was actually born a germaphobe. Never liked shaking anybody's hands, was always a germaphobe, and received a fair share of you're crazy type of attitude, and frankly I kind of thought I was a little bit crazy too. So when COVID came around, right down my strike zone, and there was some validation that I was right all along. I wish I wasn't. And I can guarantee you this, I will never, ever shake anybody's hand again.
Well, as you know, there are some cultures that don't shake hands, whether it's Japanese that bow or Thais that Y, or in India, they have different ways of greeting. So maybe some of the Western world is adopting the new ways. How about you, Bram? Anything that you would like to share that you might have learned about yourself during this time?
I think one of the major changes in the way I've been conducting business, certainly a surprise has been how much more interaction that I've gotten with all of my work colleagues now that I don't have to go to the office. So, how enjoyable that is. When I went to the past 4 or 5 years, when I was going to the office, there was a small set of people that sat next to me, and those are the folks that I would see. But now I've really had an opportunity to look past sort of the geographical constraints, and it's been a lot of fun talking with people all around the country and all around the world too. So on a much more regular basis. So I've really enjoyed that, and it's been a really fun surprise that we've had during this outbreak.
Fantastic. Well, Brent, thank you very much. Dan, great to have you. Jeff had to leave right on time, but thanks to all of you for participating. Thanks to our viewers that joined us live, and for those that would be watching the recorded episodes on our YouTube channel. It's great to have you with us. Please continue to participate in discussions. We're always looking for new topics, relevant topics. We really appreciate your involvement in these discussions. Thanks for joining Hospitality Talks. This is Abid Butt. Over to you, Sam.
Thank you, Abid. I'd also like to thank all our guests for the great input today. And particularly I'd like to ask all the live viewers who have joined us from LinkedIn, Facebook, and YouTube. And also, if you're watching the recorded, you will see here somewhere, there'll be a interesting video you should watch. This is a interview had in the past with Chris Cahill from Accor. He talks about the luxury travel recovery trends. I think you might enjoy that. So with those words, I will close this session and look out for our next event, which will be very, very soon again.
Thank you.
Thank you, everybody.
Thank you.